Sometimes being double-minded is a problem, but could being optimistic and pessimistic at the same time actually be a good thing for investors? Surprisingly, the answer may be yes. There have been lots of studies about the two halves or hemispheres of the brain. The right is thought to be the seat of emotion or creativity, the left more linear or logical. Rather than wading into that science, though, what if we just picture two voices in our head, a pessimistic voice and an optimistic voice? I think there's some evidence that people really do have both voices and they're listening to them regularly. Why do I say that? Well, let's look at some numbers. These paint a picture that would seem to be reasons for optimism. Americans' cash deposits, the purple line, are as high as they've ever been through a combination of savings and pandemic relief from the government. Almost $4 trillion. That's double any pre-COVID highs. We're spending like we're optimistic. No slowdown in the rate of spending. That's the blue line. It's been steadily increasing. And we have less debt service per dollar of income, the yellow line, thanks to low interest rates from the past. And again, that pandemic relief that allowed many of us to pay off some debt. Here are some other things to feel optimistic about as well. We have almost record low unemployment. COVID seems to be increasingly in the rear window. And hey, it's summer. Who doesn't like a good barbecue or a trip to the lake or a round of golf or a baseball game? You get the picture. And yet, our sentiment, U.S. consumer confidence, has been on a pessimistic path. And today, it's at a record low for as long as this statistic has been kept. The deep drop during COVID in 2020 makes sense. But then again, since mid-2021, we see a decline. We seem to be a moody bunch at times. But what's causing our moodiness, our current pessimistic attitude? Aside from the political rancor over just about everything, often the source of our pessimism is uncertainty about the future. When people are very uncertain, we begin to get more pessimistic. So what are some of our current sources of uncertainty? Well, here's just a few big ones from the financial and economic sphere. No surprises here. But are things really that much more uncertain than they were at the beginning of 2020? As a group at the beginning of 2020, we were confident. We were listening to our sunny, optimistic selves right up to the days when the COVID infection rate took off in early 2020. This was definitely not expected in most people's short-term forecasts. And even then at the outset, many thought it would just be a quick passing seasonal flu. It turns out that our confidence, our level of certainty about uninterrupted good times continuing, turned out to be overconfidence. The future was actually as uncertain as ever in 2019 and early 2020. We just weren't feeling that way because so many things, at least economically, were going well. This kind of pattern recurs again and again. People feel very confident, perhaps overconfident, right up until the unexpected happens. The unpredictable negative surprise that no one saw coming. Now that we're on the other side of COVID, we see these current four sources of uncertainty and we feel more cautious, as though things are more uncertain than ever, even though we live with uncertainty in the background all the time. So what do? Well, as an investor, the best things to do in times of uncertainty turn out to be the best things to do all the time. Because whether we're thinking about it or not, the level of uncertainty about the future is always higher than we think. We can't see everything that might happen. As Nobel Prize winner Danny Kahneman says, the thing to learn from surprises is that the world is a surprising place with a potential to surprise us every single day. Every investor needs a financial plan that quantifies things like goals, spending requirements, time horizons, when you'll need money from your investments or other income sources, how much, for how long. This planning process will virtually always lead to the advisability of a well-diversified portfolio, one that spreads risk around and one that doesn't run the risk of missing out on the next great companies, even though they may look small and insignificant today. Remember when Amazon was just a bookseller or when Apple only sold oddly named personal computers? This kind of plan-based portfolio allows an investor to stay invested in good times and bad and uncertain times. Warren Buffett bought his first stock at age 11. In 1941, he stayed invested over 80 years through good times and bad times. You can see why he's smiling. He's been a highly successful optimist. With a plan-based diversified portfolios, investors don't struggle with trying to predict what will happen and when. The portfolio prepares for the unpredictable, the surprising things that will happen. Staying invested when it seems like everyone else is heading for the hills is a long-term investor's superpower. No one is required to sell, whether the market is way up or way down. And the history of global markets would suggest that leaving prematurely is an almost certain way to diminish your long-term success. Bill Gates tells the story of the early days at Microsoft when he would keep hordes of cash on hand because he was afraid of a short-term reversal that might sink the company before they really had a chance to get their legs under them. He knew he had to be able to survive short-term setbacks to have a shot at accomplishing long-term success. A good investor understands the same thing. You save like a pessimist because in the short term, things can go badly, especially when it comes to stock markets. They can go down 20%, 30%, even 50% before finding a bottom. To survive in those times, you need cash and quality bonds to cover a few years of planned withdrawals. These assets are generally safer, yes, with lower expected returns, but also far less downside risk. Our pessimistic self likes diversification, especially into risk managing assets. It also expects less from future returns, and so it saves more in the present. But in other parts of your portfolio, you invest like an optimist because humans keep finding new solutions, new products, new services that contribute to global economic progress. As a stock investor, you're choosing to listen to your optimistic self, the one that believes long-term progress, even with setbacks from time to time, will continue. An optimist stays invested through thick and thin, that benefits from the incredible power of long-term compound growth, something that Einstein called the eighth wonder of the world. Investors ultimately need to be present to win. They need to be invested so when the next wave of strong returns shows up, they participate. That next wave is usually unannounced and comes by surprise. If you'd like to talk with a Foster Group advisor about how you might be able to save like a pessimist and invest like an optimist, you can reach us at this contact information. And if you have questions or topics you'd like to hear us address, please let us know. We enjoy doing that. So until next time, we'll see you soon.